Good evening. Welcome to today's webinar on career insights into quant and algo trading, hosted by CFA Institute and CFA Society India. I would like to take a moment to welcome our audience from around the world joining us remotely. I am Rajendra Kalur, CFA, Director, CFA Society India, and will be the moderator for today's webinar. Before I introduce our speaker, I have a couple of housekeeping notes to make. Today's webinar is scheduled for 60 minutes, including Q&A. 45 minutes will be the presentation and last 15 minutes for Q&A session. We'll be leaving time for Q&A after the presentation. Please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A link at the bottom of your viewer and typing your question in the box. This webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete the evaluation survey before you sign off today. It is my pleasure to introduce our speaker for today's webinar, Rishi. Rishi Kohli, Managing Director and CIO Quant Strategies, Avendus Public Markets Alternate Strategies LLP. Rishi joined Avendus Capital Public Markets as a part of the investment team in June 2021. He has over 20 years of experience in the Indian derivatives market since its inception and has been a pioneer in the Indian quant space. In his previous role at Pro Alpha Capital, he was the CEO and CIO responsible for the overall investment management and research. Rishi has been a speaker at many global conferences like Quant Invest in Paris, Hedge Funds Asia in Hong Kong, and Quant Invest Asia in Singapore. Rishi, in terms of education, Rishi completed his bachelor's in mechanical engineering from IAIP in 1999 and is an MBA from IIM Lucknow. Over to you, Rishi. Looking forward to hear your presentation. Thank you.
Thank you, Raj, and welcome everyone. Thank you to CFA Institute as well. It's a pleasure to be here and talk about the quantitative space and algo trading, something very close to my heart. And as Raj mentioned in my background, something I've been trying to do from very early days when I was a newcomer and youngster in the industry. So, I would like to start off by talking about the overall industry. So as we all know, the growth of quantitative funds in the US and globally has been very strong over the last many years, and I think it's the trend has been upward strongly over the last 20 years or so. I do remember when I started my career in 2001, that was the time when actually the quant space globally also started booming, but the real big uptrend started happening after 2008-9. So the credit crisis, had a lot to play in terms of this industry picking up for various reasons, depending on the different types of quant strategies. And I'll touch upon some of those things as we proceed in today's discussion. But what is there in front of you, if you see the chart of how the quantitative funds in the US have grown, this is just giving you the smart beta and quant mutual funds and factor-based mutual funds. So that those categories, which is more long only, obviously there is a whole plethora of hedge funds in the US and Europe, which are either managed futures or market neutral or equity long short, etc., which is not even, that data is not even included here. But even if this category you take, then, and this is a few years old because the updated data was not there, but this shows around a $1.5 trillion US dollars in just these types of quant strategies, which is quite large. And there has been a 15 to 20% CAGR growth of these various strategies over the last 10, 11 years. So, it has really grown very strongly, and the hedge fund side of it, like I said, is not covered here, but that also has grown spectacularly over the last 10, 15 years. Now, coming to India, you're seeing the initial, action in this space over the last few years. So you have some of the top Indian mutual fund houses, ICICI Pru, Tata, DSP, Access, some of these having started quant funds. Initially, obviously, these will be long-only funds because these are being launched by mutual fund houses. You also have many alternative funds via the AIF route from other large financial services houses like Avendus. You have Edelweiss and some others as well, which have these kind of long-short funds. And some of them are quant, obviously not all of them are quant, but some of them are quant related as well. So overall, on the mutual fund side, if you add up all the AUM in the Indian side, I don't think it's more than 6,000-7,000 crores even today. And on the AIF side, also not more than 4,000-5,000 crores. So you're talking about broadly 10,000-11,000 crores only in Indian markets, which is obviously very small given how large the industry is, and obviously what we are seeing globally. Now, in terms of my experience, because I've been an initial practitioner in the Indian equity derivatives market, one of the first on the quant side, have seen algo trading starting from the time I was in sell side long back. What I've broadly seen is that we've in financial markets been around 15 to 20 years behind the US, depending on the category. And of course, as I said, after 2001, and then really after 2008, the quant and passive category grew in the US and globally. So the action that we've started seeing in the last 2-3 years means that, again, that same 15 to 20 years kind of delay is there on the Indian side, but it also means that, we are at that inflection point and the next few years can be really, really interesting in this space. So there's a long way to go. There's a very open and clean slate, which is what makes it exciting, I think, for all of us present today. On the algo participation side in the Indian market, since that's part of the discussion today, so you can see some data here on the top left side, the NSE cash volume breakup for September 2021, 2 months back is shown. So as you can see broadly, there's a 50% sort of participation of algorithmic trades. 50% is non-algorithmic, but if you see the non-algorithmic trades also, the internet-based trading and mobile trading has obviously, as we know, picked up a lot in the last few years due to a lot of fintech plays in the market and other online brokerages like Zerodha, Upstocks, etc. So part of that is also sort of systematic at least. It may not be pure algo, but as we know, there's more sophistication happening on that side of the market also. So some of this I would also sort of club it with algo. Obviously, there'll be much simpler algos, but it will still be some sort of an algo. And of course, the pure algorithmic trades, you see the largest participation of co-location, which obviously, as we all know, is more important for what is called high frequency trading, which means trading at really, really low latency. And then algo, normal algo and DMA, those categories are more what institutions, normal long-only funds also use a lot of algos and DMAs from the sell side. And that is also coming into the algorithmic data. In terms of, NSE and NIFM have done some research around all this data on the algo trading side a few years back. And therefore, this data is a bit old. But basically, you could assume, 8-10% higher numbers right now based on just my experience and industry understanding. So as you can see in 2015-16 also, this shows cash market 42% and FNO 52-53%. And as I was showing you above, in September, the cash market is around 50%, so around 8% higher. So on the equity FNO side also, you can assume around 60%, would be the participation from the algorithms. Then the other interesting data point here is that on the cash equity side, the larger participation is from client trades, and on the equity derivative side, the larger participation of algos is from the proprietary trades. Now that's interesting, but also quite logical, because as I was touching upon just a minute back, that on the cash equity side, there's more participation from a lot of traditional long-only, long-short funds, and they are using algos just for simple, kind of execution, which are more time split or volume split or just volume participation, etc. and therefore that client participation in the algo is higher. On the equity derivative side, there are more people doing HFT, there are more prop traders in the market, whether it's local Indian props or the global banking props, who are active in the Indian market. And therefore, the equity derivatives share in algorithmic trades is more on the prop side. So that's the distinction. Now, after having covered the initial part of the quant and the algo space, both globally and in India, I would like to spend the next 10 minutes also going into the types of strategies that are possible, especially in India on the quant side, and then we'll relate it to the roles and opportunities that are there, which we all want to discuss today. And what I'm doing is I'm sort of excluding long only. I did mention the data about the long only side, and I know there have been sessions, via CFA on the quant long only side, which is more factors and smart beta, etc. Obviously, for example, even I use those kind of things, but use it more in a long short, theme and category of hedge fund rather than pure long. So I thought it would be interesting for all of you to understand the various categories within quant, excluding pure long only as well, because there's a huge world out there and less talked about. So I would broadly classify it between high risk, moderate risk, and low risk strategies. High risk strategies, there's something called managed futures, which personally very close to my heart, and I've been doing for the last 10, 12 years live in both Indian markets and even Asian markets, where I've managed an Asian fund in the past. And this is less understood from a sophistication perspective in India, but globally it's one of the largest hedge fund categories. So in India, we all know about equity long short, which is the second high risk strategy mentioned there. But what you will all find surprising, I mean, most of you, I'm sure some of you may have seen the data, but a lot of you will find surprising is that managed futures as a hedge fund category is actually become much larger than equity long short if you just look at the hedge fund AUM data. And the whole trend of that has happened after the credit crisis due to a lot of the large pension and sovereign funds actually allocating to the managed future space, which is something that, sitting in India, we can't even imagine. And there are very large funds which are 20, 30, $40 billion in that space, single funds. So it is quite a scalable and quite attractive strategy from a portfolio diversification perspective. Then equity long short, I think broadly, we all understand, just like how we do equity long, whether it's based on factors or other technical or statistical parameters. Similarly, you can have a portfolio sort of approach where you can say from BSE 100, based on certain theme or factor or statistics, pick the best 10 stocks and the worst 10 stocks and say that I will go long the best 10 stocks and short the worst 10 stocks from the ranking that I have done. So that's one example of equity long short. And of course, market neutral is sort of related, where I can make the same thing completely market neutral. Or if I want to have some directionality in the long short side, then I can have some exposures and not make the exposures completely zero. So which is why when I say moderate risk strategies, market neutral I would put there, statistical arbitrage I would put there, even option trading, because these are strategies which are not fully like arbitrage where there is almost zero to minimal risk. There is some risk, but since the exposures of zero or close to zero, and the correlations and other factors that you're studying are very tightly linked to each other, so therefore the risks are typically low. But having said that, obviously we have all heard about many events globally where such strategies have faced difficulties, and therefore risk management is obviously key to some of these strategies behaving in a stable manner. Low risk strategies, I would put high frequency trading there and just plain arbitrage. Like in India, for example, people do NSE to BSE, simple cash to cash arbitrage. We do cash futures arbitrage. So those are as close to zero risk as it comes. So obviously very low risk. There is some operational risk there, which I will talk about in a minute. So on the high risk strategy side, to drill down into some of the key features and what is required and not required there. So, you need more clear focus of finance and understanding of financial markets. There's a little less programming math involved. Obviously there is if you're a full quant, but you don't need it as intensively as some of the other strategies. Typically, we are working on daily, weekly, monthly data. We are not necessarily working on intraday and tick by tick kind of data. And then the quantitative research focus in these types of strategies is used to identify signals to generate alpha in the case of managed futures, for example, and then to identify strategies to generate alpha and reduce risk for long short funds. So on the long short side, you're trying to improve your risk adjusted returns. For the same level of risk, you're trying to increase the returns, or for the level of return you're targeting, you're trying to reduce the risk. And that's what your research is going into, to generate, identify strategies which can help you do that. So here, having the right mindset, identifying the comfortable risk reward ratios and levels, depending on the objective that you have for your strategy or your fund, is more important. And like I said earlier, the practical knowledge of financial markets and a lot of common sense and creativity is important. For example, this is a category where I focus a lot of my energies on. And I would spend a lot of time reading a lot of the latest quant research being done globally, a lot of the papers, academic papers as well, and then try to drill it down into some commonsensical understanding at my level and relate it to my knowledge and experience in the Indian markets, and then sort of take it on from there rather than just applying the math in the research that I'm reading blindly. So here you need to have the capacity to read the complex math, but make it very simple and commonsensical, tweak it to, as per your experience, to what you think can be an interesting idea for the Indian markets, and then be creative around the solutions and the data that you are analyzing. So these kind of strategies obviously very popular and very useful for hedge funds, which either can trade with leverage like globally, but you can basically play around with when you want to increase or decrease the leverage very smartly so that your risk doesn't increase, but you're improving your risk adjusted returns. Or even in our case, for example, in the Indian markets, we are managing AIF funds where, as some of you will know, the regulatory restrictions are there and I cannot have very high exposures. I can only go up to 200% gross exposures, but still you can take advantage of dynamic changes in the net and gross exposures using these kind of strategies and still come up with something very interesting on the risk return spectrum. Moderate risk strategies, typically positions are hedged. As I mentioned to you, things like market neutral, stata, so either zero or very, very low exposures. But still, I'm not putting it in low risk. I'm still putting it in moderate risk because these are typically based on very strong underlying statistical relationships. You're looking at things like correlations, co-integrations, all of this. And again, as we know, these kind of things can get strained, can get broken, can get realigned for certain periods of time. And, as the famous saying goes, markets can remain irrational longer than one can remain solvent. So therefore, rather than, just thinking that, okay, these relationships have to get realigned or have to come back at some point, which is true, it will come back at some point. But before that, if the fund is completely bankrupt or completely broken, then you will not get a chance of, seeing that coming back. For example, LTCM, something like that did happen and you had the best of minds there. So sometimes being very practical with the risk management and being aware of, where the risk may not be there day to day, but even if it happens 1 or 2 days in the year, it can be very, very dangerous, is very important to understand and track and be patient and have the right risk management in place. So here, a lot of research is required to unearth the relationships which are stable. Very good execution capabilities are required. For example, statistical arbitrage opportunities, which are in a simple way, locally, a lot of people call it pair trades. So, those opportunities can come in at any point in time, intraday, day to day, and you need to, say, capture a certain ratio very, very fast. So good execution capabilities are important because the opportunity may not last very long. So here, obviously, some understanding of finance is required, but it can be more suited for more mathematics professionals. So use of mathematics and programming obviously is much higher in this, and it can be used both on the hedge fund side as well as on the prop trading side. Risk management is key, as I mentioned to you earlier. Low risk strategies like HFT, prime example, very popular globally, the closest thing that comes to free lunch, in my opinion. But why is it not so easy? Why is it difficult? Is because it is very technology heavy. It requires a lot of significant investment in execution infrastructure. Even before I can think of using HFT, I need to spend a few crores just to build the initial infrastructure and hardware that is required. So it is operationally also intensive. And therefore, there is a barrier to entry in the first place itself. So as a retail guy, just standalone, if I want to do something in that space, it's almost impossible. The second thing is for institutions who are trying to run large and scalable funds. For example, for us at Avendus, sometimes this may not be the focus area because it isn't as if you can deploy hundreds and hundreds of millions of or billions of dollars into strategies like this. So the opportunity set is limited, scalability is limited, but very suited for proprietary funds, both, like I said, local and global banks. This can be very, very highly appealing. And it is a little more suited for technology professionals because a lot of technology is involved. So that and programming, much more is involved relative to finance. So very low market risk, but very high operational risk, because we've all heard of algos running wild, or some servers being down, or some fat finger trades having happened even though machines are being used. So those kind of things are the more of the risk here rather than any market risk. Now coming to the work involved in different areas, now that we've covered the types of strategies. So I've broken it down into the 4 functions that are possible. So, you can work on the quant side within trading, within research, within risk management, within analytics. So what do you actually do in each of these functions? So in trading, it will be more execution focused strategies. Your key role and function is more to focus on how best and how most efficient the trade can happen. And here, advanced tools like machine learning, artificial intelligence are also used. And a lot of execution focus, algos around that are the primary focus. What happens before and after the trade is not necessarily as important. On the research side, on the contrary, the focus is investment. You're identifying signals and ways to generate alpha. It is more related to asset allocation and portfolio construction methodologies. And therefore, the quant work is really, the quant research is really happening on that alpha signal generation. And therefore, it is sort of pre-trade, quant research that is happening. So that's how it is different from the trading focus and trading orientation. Then risk management, obviously there will be some risk management happening, before, because it is embedded into the portfolio construction process. In fact, I mentioned to everybody that well thought out portfolio construction methodology and asset allocation methodology, itself is a very big risk management, because if you've thought of diversification, you've thought of combining non-correlated models and, having different strategies across different time durations. So then there's a lot of risk management which you've already done because of that. But post that, whatever other post-trade or post the portfolio being constructed, whatever further risk modeling or risk management or risk tracking can be done, all that is also obviously a very big part of risk management, and there the quants add a lot of value, because you can actually look at, even for certain factor models and other things, you can actually deconstruct the portfolio and say that, okay, this portfolio has this kind of bias, and is that the kind of bias or that the kind of factor that I wanted participation in? And maybe, you did not, but you've not realized by constructing the portfolio using whatever tools you did, that these kind of factors and biases are crept in. So that can get highlighted via the risk modeling and risk factor models that the risk quants may be doing. And then analytics, post-trade analytics, portfolio performance, So a lot of data visualization can happen there. So both from the trading research side, what all can be done and what all has been done, analytics around that is something that the analytics functions quants can do. And obviously a lot of pricing of securities and other things is something that happens in this function. Now again, taking the same functions into account, what are the roles across different types of firms and different types of functions. So trader, obviously a quant trader, there will be jobs across hedge funds, mutual funds, prop books, even the sell side meaning brokers, because brokers also use execution algos and DNAs, etc. So there is use of quant traders and developers on the sell side as well. On the research function, you will typically be an analyst and then work your way up towards a portfolio manager. And these functions are obviously there in hedge funds, mutual funds. What we are seeing, the initial action in the Indian space and globally obviously is very large. Even on the wealth management family side, family office side, it started to become a bit more sophisticated in India. Still early days, but at least much better than 5 years back. So there can be ways to be an analyst in those areas as well and be using quant methodologies. And then prop books, obviously, we touched upon some things that can be done there. Is also something where research quants can be very useful. Risk management, again, hedge fund, mutual fund, prop books, sell side. Exchanges, very important because exchanges need to have a lot of risk management in place, both from an operations perspective, from a surveillance perspective. So all of that is also something a risk quant can do. And then on the analytics side, asset allocators. So in India, obviously we do not have too many fund of funds, but globally a lot of fund of funds and a lot of pension funds, sovereign funds, who invest in other hedge funds, for example, who invest across a lot of asset classes. So there they will do a lot of asset allocation based quantitative research and portfolio construction and analytics around that. So there this will be useful. And then a lot of data providers, data modelers, like, Barra, FactSet. So some of these places, obviously, you're more focused on the analytics side. Then the skills required on across these functions. So on the trading side, for hedge funds and mutual funds, you need more of basic understanding of programming because you'll typically be using the much simpler algos or execution methods. But for HFT and other arbitrage strategies, as I was mentioning earlier, you obviously need much more advanced understanding of programming and a lot of technology and infrastructure will come into play. And machine learning, big data techniques, etc., can be useful on the trading side. In contrast, on the research side, as I said earlier, also a strong understanding of finance is more important. Some practical and live understanding of financial markets becomes more important. Statistics knowledge is more important than programming, but obviously basic programming knowledge will be needed. Practical live knowledge, as I said, is very important. In fact, that I would say is very important across all the functions, in fact. But for research and risk management, for example, it is even more important. And on the research side, I would put this as the most important thing, that a curiosity and eagerness to constantly keep on learning is very, very important. Because as I said earlier, you should have the capability to assimilate a lot of research being done globally or new ideas that are being thought of or discussed globally, while at the same time doing your own research. And then, constantly learning, constantly tweaking your ideas, constantly brainstorming. All that I would put as the most important thing on the research side. For example, a lot of the things I have learned have been on the job and have been much more important than things I have read or studied. So that is very, very critical in my opinion. Risk management side, again, some basic programming knowledge, but very good understanding of finance and statistics, because you will use a lot of stat and maths for all the risk modeling and scenario analysis and sensitivity analysis that you do. And then data visualization techniques, both for risk management and analytics, is important. Analytics, again, high level of programming and big data and machine learning kind of things can be useful. Then just a few minutes on the types of things that can be done in algorithmic trading, because I like to break it up into two areas: more strategy focus and then more execution focus. So strategy focus is things like, trend following, mean reversion, pattern recognition, those kind of techniques being used, whether it is high frequency, medium frequency, low frequency, what is globally called delta one trading. So that strategy focus can be there and algos can be used for it. And again, on the option side, obviously algorithms are very important because you need to do volatility trading, gamma trading, track the Greeks, maybe trade based on that. So your algos need to take all of that into account. But there, the strategy is slightly more important. So how you are constructing the strategy, what alpha, signal the strategy is sort of deriving, all that is a little more important. Obviously, the execution is important because you're trying to capture those opportunities of the alphas, at a relatively faster pace. But again, it depends on the frequency. So low, high frequency, obviously that is much more important. But medium frequency or low frequency trades, when you do in those categories, then the execution would be a little less important. Whereas on the execution focused trades, where you're either doing some benchmark based trading or you're doing spreads, whether options or futures, then the execution capability is much more important, because the strategy itself is very, very simple. And, even a school going kid can sort of understand why one is doing the strategy. But to be able to execute it, capture those spreads and opportunities, do it at the best efficiency possible in terms of, for example, implementation shortfall, where, your impact cost slippages are as low as possible, so that whatever you're modeling, your live performance is as close to that as possible. All of that is what is tricky and what the algorithms focus on. So again, slightly different ways and different focuses of using algos. And that is where, we all need to think, okay, where does our personality sort of fit in? And therefore, what can be more suitable for us over time? So initially, it is obviously not as easy to understand that. But as one dabbles into the basics of various things within the algos or the quant side, one starts getting an understanding that, okay, this is what is more exciting to me, or this is what fits my personality better. And getting that understanding as fast as possible is also very key to, advancing your career in a faster manner. Then this, the next two slides, this and the next, it's quite detailed. I'll touch upon some key aspects, not obviously go into each of these boxes, but it's a summary of both hard and soft skills required across different types of firms, and within those firms across different types of functions. So some of the more hard skills or technical skills we discussed also in some of the past slides. For examples, on the hedge fund side, for a researcher, mathematical skills are required. So it's high here. Programming skills are required, statistical skills are required, so all of this. Whereas for portfolio managers, in contrast, mathematical skills may be medium, but programming skills need to be high. Statistical skills need to be medium, but financial concepts needs to be very high. So this is how the relative importance of these different technical skills across functions and across firms is what makes it very interesting. And you can see some of the differences here. For example, on the prop side, the risk management functions also is very, very important. And there, obviously, the risk manager having mathematical skills and statistical skills, etc., is much, much more important than many other areas. But at the same time, I would, take a minute or two to spend time on the soft skills, because soft skills are really, really important, in my experience. So again, something difficult to teach, whether in undergrad or postgrad courses or in professional courses and charters like CFA, but very, very important. For example, here you see critical thinking being very important in hedge funds across the three functions mentioned here. Decision making obviously is a higher importance for portfolio managers because they have the final authority to decide what to do. But again, analytical thinking, both for researchers, portfolio managers, very important function. Creativity, I mentioned it earlier also in the discussion, very high and very important for researchers, and the passion for the job. So a lot of courage and curiosity is required for quants on the research side, whether it's hedge funds or other firms as well. And then something which is maybe not even mentioned here is, adaptability and collaboration. So I mentioned curiosity also earlier, and then adaptability and collaboration is very important. Adaptability because a lot of new ideas keep coming. You need to keep brainstorming, yourself, keep thinking also with your team and colleagues, keep brainstorming. And you need to be adaptable to new ideas and try to imbibe new thinking into whatever framework or decision making that you do. Because otherwise you sort of become obsolete very, very fast. With the pace at which new techniques and new technology and new ideas are coming in globally, you can get lost very fast and become obsolete very fast. So to be able to tackle that, I think high energy levels, being able to adapt well, having high curiosity, and at the same time collaboration, because it's going to be very rare that you're going to be the only person in any of these firms and be doing quant. So if there is a quantitative focus, whatever be the type of firm, whether it's hedge fund or prop funds, as mentioned here, next slide I have sell side, analytics, HFT, but what is more important is that the collaboration is required. And in fact, in the same firm, you would have all types of quants, right? Technologists or, programmers, you would have researchers, you would have portfolio managers, you would have traders, and each of those functions can have people, who are focused on quant. And obviously for the strategy to be fully efficient and fully deployed properly, you will need collaboration across all those functional quants. So the collaboration part is also very, very important, and something important to remember, because a lot of times, we as researchers are very happy sitting in our corner and not bothered about what else is happening in the world. But when you come to the hedge fund or the prop desk or the sell side, then you would have to collaborate, and therefore that also becomes an important soft skill. And some things on the technical side, while broadly mathematical skills, programming skills, etc., are mentioned, but some things specifically, like obviously, some of you know that programming knowledge, at least one of Python, Java, C++, some statistical analysis software knowledge like MATLAB or R, typically are required in a lot of these functions. And then on the mathematical and statistical side, probability obviously is most important, linear algebra, some basics of derivatives, pricing, Greeks, all of this is quite important. But as I mentioned earlier, a lot of the learning finally happens on the job. So being quite aggressive on the job, taking in as much learning as possible, in the initial few years, and really learning from your colleagues and your seniors, and hearing from other market practitioners who have a lot of experience in the markets, reading a lot of books, a lot of papers, a lot of journals, can get you up the learning curve very, very fast. And that is in fact how I got up the learning curve very, very fast in the first few years of my career. And so I can't stress enough the importance of, doing all of those things and learning from practitioners, colleagues, books, and not reinventing the wheel. A lot of what we may be thinking has already been done earlier, and we can put our new ideas and knowledge to the test, but not at the expense of wasting time again on things that are widely understood. So getting up the learning curve on that very fast becomes very, very important, according to me. Now here I would just take a step and discuss about some key cognitive biases. So we discussed about different quant areas, algos, different rules and different functions, different firms. But net, what is a quant process or a data-driven process helping you compared to other facets of investing? Important to give a minute and understand this, because there are a lot of cognitive biases that we as humans are exposed to. Some of these are mentioned here. Recency bias, for example, is the tendency to give more importance to the more recent information, market conditions, etc. So for example, when I run my managed futures quant strategy, then a lot of investors or colleagues will say that, okay, markets have been hugely trended and volatile recently. And so that is what will end up continuing, or that is what markets typically do, the last many years. But that's not true. The conditions keep changing. It's just that we as humans tend to remember only the last 3 months or 6 months or 1 year. We don't really remember what happened 5 years or 10 years back. And that is a problem in investing. You need to be aware of that. And obviously a data-driven process helps you eliminate that, for example. Similarly, there is a herding bias, there are confirmation bias. Very interesting is the gambler's fallacy or loss aversion bias. And some of you may know there are trader thumb rules that a 2:1 or 3:1 risk-reward ratio is important, before you shortlist a trading strategy or a quantitative research process, shortlisting some alpha or some signal. You need those kind of risk-reward ratios or Sharpe ratios, etc. And all that comes from this loss aversion bias thinking, because research has shown that typically, we dislike losing a lot more than we enjoy winning. And the percentage of that is that 2:1, 3:1 number. You dislike losing 2 to 3 times more than what you like winning for the same amount. And therefore, having that risk-reward ratio in whatever you are doing actually helps tackle these kind of cognitive biases. So these are important to understand and appreciate, because this is what puts you ahead of the rest of the disciplines in investing, trading, related fields. Now, finally, coming to the qualifications, required and aspects of interviews, etc., for initially getting into the space. So initial qualifications, obviously, on the post-grad side, MBAs, CAs are typically desirable for entry-level roles also. Engineering, of course, fresh engineers are welcome for certain roles which are more technology-oriented. As I mentioned, some of the HFT things or pure execution algorithm-based things, maybe a hardcore engineering and math kind of background is good enough. So maybe even a postgrad is not really required. But along the way, obviously, those kind of people will have to take on additional qualifications like a CFA or financial engineering, etc., if not more advanced courses. And for others, for MBAs, CAs, obviously some basics around portfolio management, research, risk management, some basics of derivatives, etc., is all covered in MBA courses and CA courses nowadays. And therefore, that is typically desirable for entry-level roles. CFA obviously is a very valuable additional qualification. And I've also highlighted how that curriculum helps, because portfolio management, portfolio construction, financial projections, cash flow analysis, basics of risk management, asset allocation, derivatives, some of these things are very well covered there in a very practical manner. And as I've already mentioned, that I'm a big fan of, more practical and commonsensical things which we can relate to, along with the more harder skills that we develop. And then for very hardcore risk roles and very deep research roles, obviously PhDs can be a good fit. Globally, as some of you may know, quant firms typically employ a lot of PhDs, and you will have, a lot of quant firms having, 100, 200 PhDs itself on the research side. In India, of course, it's different because we are just sort of starting out. There are not too many quant firms first to begin with. And even if there are, like ours, for example, the teams are very small, and you will typically have, one portfolio manager and 1 or 2 quant research guys and maybe 1 trader or 1 risk guy who is quant. So typically very small teams, and therefore the plethora of PhDs that you see in global firms is still not so common locally. But as I mentioned at the beginning of the discussion today, that we are just starting to get into that inflection point where I think in India, the quant and algo space will really boom over the next 10, 20 years. And so a lot of the things that we are seeing globally will end up happening here. PhDs are interesting from the standpoint that, they are used to doing their own independent research, going very deep into certain specific, niche areas. And they're also used to reading a lot of other research in their areas and then, dumbing it down for themselves and then figuring out other new ideas on top of that, which as I mentioned also earlier today, that can be very interesting way for researchers in the quant side to pick up new ideas. So that is where the PhDs sometimes become a good fit because they are already used to doing that. Secondly, many other disciplines, right? So you could be an expert in, for example, language processing or something. And those kind of skill sets are very similar to, the kind of work one does in pattern recognition side of the quant field in financial markets. So therefore, sometimes those kind of PhDs from those disciplines, whether it's maths, physics, or other areas, can be useful in financial markets as well. And of course, they cannot work independently. They would work in a team where someone who has good practical knowledge of financial markets would team up with them. And that is again where that teamwork and collaboration perspective that I mentioned earlier also comes in. And then financial engineering, I briefly mentioned, is also useful for certain roles because where there is more maths involved, a lot of pricing of derivative securities, structured products, etc., which ends up happening in a lot of the large banks globally, are places where financial engineering can be used more. And then aspects of the interview, I'm sure all of you, are focused on this. So EQ, as important as IQ, you may have heard it earlier, but again, cannot stress enough the importance of that. As I said, no one is going to work in a silo. There will be teamwork happening. One will need to sometimes understand the ideas from other people in the team, whether it's someone on the quant side building an execution algorithm, but first fully understanding what the quant researcher or portfolio manager is actually trying to implement, and then figuring out what is the best way to build the algo for the same, means that you need to be able to listen, you need to be able to understand, you need to be able to brainstorm with, quants and other disciplines within your firm, and then sort of work together as a team. So that EQ becomes very important because of that. And then, of course, not at the entry level, but as you progress in your career, then track record is very, very important, especially for portfolio managers and prop traders, etc. The track record ends up becoming more important than even the hard skills that you have over time. Willingness to think out of the box, as I said earlier, creativity, continuously thinking new ideas, adapting, reading new things, and then building your own ideas on top of that is, I think, the most important. And obviously understanding of linkage between risk and returns, because that's what you're playing around with. The idea is always to have, better risk-adjusted returns in whatever one is doing. And then it is also important, to control your own psychology. Despite being full quants, I've seen a lot of people, trying to tamper with the algorithms or trying to tweak just for the heck of it, just because things may not be working well at certain points in time. So it is important to distinguish between, models going wrong versus, any strategy or any model will go through its up and down phases. So there will be good and bad patches, except for very, very pure arbitrage. There's no free lunch. There's nothing which will work all the time. So understanding also the cycles where a strategy or a model will do well and cycles where it will not do well is very important. And then going through all those patches without really changing anything. Because understanding at what frequency your model is trading and at what frequency, therefore, any change to the model or any parameters make sense. Because again, there are statistically defined ways of what is more robust and what is not. So correctly applying that becomes much, much more important over time. And that is where the psychology and the mindset thing comes in, which is, I think, very important. And then, of course, more hard skills and technical understanding, whatever programming knowledge, statistical understanding, mathematical foundation, financial market knowledge. I mentioned some aspects of that in different roles and different functions that are required. So accordingly, obviously, one will be tested on some of those things, some using direct questions and direct questions about certain concepts, etc. And in some cases via case studies, just to see whether you can think a little out of the box and derive meaning from slightly unstructured data also, for certain roles that may be important. So that may also happen in certain interviews. And then obviously assessment of personality traits. As I always say, that common sense is highly uncommon. So, sometimes the interview will focus on that, if you read an academic paper, or you have a very academic idea, then, can you convert that into a practical model, or do you remain fully academic? Because as I mentioned earlier in today's presentation also, that, LTCM had a big disaster, and I'm sure some of you have read about it. And despite having Nobel laureates and the best, quant guys in the world, if that can happen, then it means that finally at some level, common sense and common risk principles, one definitely needs to make sure one has not forgotten about or abandoned. And then tenacity, diligence, integrity, teamwork, integrity, very important, and tenacity, diligence, I think in anything on the side of research or programming or mathematical concepts, all that will always come in. Without that, one cannot really move to the next level. So all of that are obviously things that will be assessed in the interview. So it will be a mix of hard and soft skills, and your ability to think out of the box, and how behaviorally, you can handle new situations and you can adapt, will also be very important. So with that, just one final thing, I always find it interesting, given our love for cricket in India that we all have, despite the poor showing that we've done recently in the World Cup, but our love for cricket will...
Rishi, we will be able to... Rishi, sorry to interrupt. Can we complete it quickly? Because
yes,
we need
I'm
some
almost
time.
done.
Yeah.
Yes, I'm done. Thanks for reminding. So yeah, this is just a quick slide to summarize that on the quant side, you can relate it to cricket. You need discipline. That's what a quant process does. Diversification is important. Techniques, time, duration, strategy, and law of large numbers. That's what a data-driven approach does. The more data that you have and the more trades you do, reality gets closer to expectations. And finally, you're trying to get the best risk-adjusted returns possible. So all of the soft and hard skills I mentioned earlier are basically moving you towards getting into this kind of a process to make your entire modeling very robust. So with that, I come to the end. Thanks a lot for hearing me out, and open to questions. Over to you, Raj.
Yeah, thank you, Rishi, for this very insightful presentation that, was so interesting that I almost forgot that I also need to keep the time. As a reminder, of course, many of you have already submitted a lot of questions. I'm not sure whether we'll have enough time to cover that, but if you have anything interesting in mind, please do share it on the Q&A box, and I'll try to, address that question to Rishi if possible. So let me just quickly get underway on the question and answer side, Rishi, and let me also start with something that is very dear to you. You have been a pioneer in this industry, and you had a startup on Algos. So there is one question on that from our delegate, advice for startups developing strategies and trying to break into the algorithmic trading world. Also, any books, academic or non-academic, that you'd recommend on that?
So books and all, I think, given the paucity of time, I will definitely share a list of books, both on the Algo side and, generic quant side later. And I'm sure, Raj and his team and CFA Institute can share that. So I will not go through the list of books right now. But otherwise, some of the things I touched upon, starting out, obviously, talking to a lot of the practitioners, whatever is the focus that you have, because again, a startup and the quant and algo space is very large. As I mentioned, those different types of strategies. So what exactly one is trying to do, based on that, the focus will be either more on programming, either more on maths, either more on the diversification principles. So based on that, one has to focus, have the right team accordingly, and then, have the right culture within the team. I think all of that is most important while starting out.
Yeah, thanks, Rishi. One more question on, how do you test new algorithms and make sure downside risks are managed?
Yes. So, we are talking about quant and algo. So data, right? Data is the new oil, and we deal with data day in, day out. So cleaning the data is most important. A lot of the data is, not very clean in India. For example, when you look at the fundamental data, when we are building factor models, whether long only or long short or market neutral, fundamental data in India is not clean, whatever database or whatever source you may use. So a lot of time needs to be spent even before getting into actually testing the signals on cleaning the data. So that I would put as the most important. Secondly, going back into time as far as possible. As we know that in our backtesting and simulations and whatever else you are doing, you obviously need to go back. And India obviously has only 20-30 years of data that you can use depending on the strategy. So you go back that entire 20-30 years, don't test it on only the last 5 years. I've seen a lot of people saying that, okay, this strategy works well last 5 years and it's great, but that is not the case. You need to test it in different periods in the last 20-30 years. And more important than that, if you can even go global and look at it for the last 50 or 100 years, S&P has data for the last 100 years. So my managed futures models, I go and test on the S&P also. And that gives you a much better feel of what can be the good and bad patches for the strategy going forward. So that is very important.
Yeah, thanks, Rishi, for this. And also related to data, there's a question on what exactly does a data modeler do? And how is it different from conducting research?
So conducting, non-quant sort of research, obviously you're using a lot of discretion. So there is always going to be some overlap, between two researchers. So let's say a traditional fundamental researcher would look at, a lot of the fundamental metrics, earnings growth, ROEs, ROCs, operating margins, cash flows, debt equity ratios. But, he would look at all of that, meet the company management, try to get a good soft feel also about what the management is saying and how confident they are feeling, combine all of this into some framework and basically use it as an input rather than a hard, filtration. Whereas a data modeler or a pure quant guy would say that, okay, this is the way I would combine different factors. Based on this combination, I would do this ranking. And then on that ranking, whatever best stocks come up, I would invest in them. Then beyond that, I'm not really applying my mind or doing any other soft checks. Or on the other side, use it as a very hard filter that, okay, if the ROEs are not above 15%, I'm not even going to look at that stock. It doesn't matter what other thing may appeal me on that, right? Those are two different ways of doing some quant research on the fundamental side. So that's how you would differ from a traditional person.
Yeah, thanks, Rishi. And there's a bunch of questions on, additional learning, certification, etc. Of course, you covered a lot in your presentation itself about how CFA would help. But there are certain questions on, something like whether financial engineering as a qualification would work. What about actuaries? Do they have a standing in this kind of setup on Algo and Quants? And is a CQF certification useful? So I think a whole host of questions from our audience who believe that and are very curious about getting into a career on your lines would be eager to know and learn more on this.
Sure. That is always very important. So CFA I mentioned obviously is important. Apart from that, I did touch upon Masters in Financial Engineering is good. But as I said, it is a little more useful. It's a little more math intensive and a little more useful in more pricing of securities and structures, etc., which is more useful in a lot of the large banks and related roles. For a lot of the hedge funds, nowadays you do have masters in quantitative finance also. Some of that may be also quite interesting. And then CQF is also good, but again, a little more intensive on the math side. Again, if you're more interested in risk management, and FRM is also good. So again, depends on the kind of role you want to get into. And if you want to get a good overview of everything and then sort of learn on the job further, which I said anyway will end up being very, very important, then just pick one of these things after going through the entire course. And as long as it's a good institute and you're going to have good fellow students, because again, learning, brainstorming from peers is, I think, very, very important in this field and set you up for what you need to do in your career going forward.
Yeah, thanks there. And of course, let me just pivot in terms of, when somebody is starting a career in a fundamental research, analysis, etc., and wants to pivot into your area, then how would that approach be? I mean, is there some kind of a footing one can get?
Yes. So from traditional research, for example, I do have some colleagues with me and I've seen other friends also pivot. So if one is a traditional fundamental research person and wants to become more of a quant, then obviously getting into one of these certifications we discussed would be important, to get the basics skills required in place and to also get an understanding oneself on as I said earlier, which of those areas can suit one. So to understand that. And of course, nowadays in India, as I mentioned, because we are in early days, so there are not too many firms and too many roles right now. But what is good is that a lot of the global players do have their outsourced units, KPOs, etc. in India. And one does get a chance to go into those kind of roles from a traditional background also. So one can then try to get into a job like that. And then, like, for example, one of my colleagues used to work for Morgan Stanley on the quant side and back up some European quant team doing European long shot. So something like that one can get into as well, apart from pursuing one of these certifications.
Thanks, Rishi, for that. Some questions on, why is, that's an interesting question, because you touched the behavioral part quite well there. And, one of the very few who have actually covered the behavioral part as well in the presentation. So why do you think EQ important in quant? Because you go by figures, hard figures, and where is the EQ coming across?
Yeah, so the EQ, as I was trying to explain, is more important from a couple of aspects. One being the teamwork that I mentioned. So that's where the EQ comes in, because if you don't have that, you will either not be able to work in a team or understand, what the other functional quants may be telling you, and also to get, the feedback from the market or from whatever you're doing, because you may be doing something which is right, you may be doing something which is wrong. So, if you don't have the right EQ, one always feels that, okay, I'm an expert in this field now, I cannot go wrong. And as we all know, that markets always tend to punish that kind of behavior. So that is where it also comes in very well. And then the humility, having humility, trying to continuously think of new ideas, having the capability to adapt. So some of that doesn't come in if the EQ aspect is not there. So obviously the EQ aspect is not required for the model that you're building, but a lot of aspects in terms of the feedback loops that get created, that is important.
Yeah, and a lot of questions on, because the market here is just developing in a nascent stage, and the data that you have shown also proves that. I think one question from my side is, why is that, you put in data that is fairly dated, that is 2015. That apart, I think the ones that are coming in is, how do you see this kind of algo HFT breaking out in India? Where do you see are the important triggers? And would it pave the way for more sophisticated products like hedge funds, etc.? So in a sense, where do you see the important triggers? And why do you see that the data is still dated and you didn't get the, not real time, but at least the relevant data?
Yeah. So, I mean, the data is not structured properly, not reported properly. A lot of it is obviously, at the exchange level or regulator level. And it is something very new for, even newer for them. So when we're talking of us as industry practitioners, just scratching the surface and it being early days. Obviously for the exchanges and regulators, etc., it's even more early days because, India has not seen all of this earlier. So that is why a lot of the data is there somewhere, but it's not collated properly, not structured properly, not disseminated properly. So in fact, that is one of my goals also to, partner with the exchanges, fellow industry participants, and try to get some of the basic data in place at least for everyone. So that is partly the reason for it. But as I said, broad, estimates are very easily possible. So as I mentioned, we are seeing 50% in that data, but you could say 60-65% right now is the algo participation. So that broadly is correct. When you talk to the exchanges or other people also, you get that sense that that would be your correct data. So it's not that different as well. One does get a sense of what is happening. And in terms of breaking out, it's already started happening. So as I said, this is the inflection point. Last 10 years have been slow. So people like me who've been around for 10-15 years, doing it on a live basis, even on the buy side, forget about the sell side, which we've been doing from a few years before that also. But even on the buy side, things that we were thinking would start happening 5 years back have started happening in the last 1 or 2 years. So we are at the right inflection point, because see, when do all these things boom hugely? When some of the leading players in the space take notice, they start imbibing processes into their core functional areas also. And you've started seeing that happen with all the big boys and the traditional names in the mutual fund and financial services side, starting quant funds. And even those who are not starting quant funds or, are not in the non-quant funds also, a lot of them are using certain quant inputs and quant researchers. So that is the sign of an inflection point having been reached. So the next 10 years is very, very exciting. I think it will be similar to what was seen in the US from 2001 to 10, which I mentioned also.
Yeah, Rishi, just since we are running out of time, just last two questions that I'll do and I'll frame it together. Sure. One is, do you see, I mean, you may covered largely the equity part. Do you see algos in FICC, fixed income currencies and, commodities as well in India? As well, the other question is, which risk category do you put portable alpha strategies?
Yeah, sure. So the first question, definitely. In fact, I myself do a lot of quant on the currency and the commodity side. Obviously, you are restricted to the more liquid ones. So currency, obviously INR, USD in India. And obviously, if you're going more global, like I said, if you are sitting out of India but doing research for some global funds or global banks, then obviously the whole world is open to you. So currency, commodities, fixed income, everything becomes important, and you can apply your quant principles everywhere. And we do some of that, and I managed an Asia fund earlier, so I've done that. But in India specifically, if you want to look at it, then INR USD in the currency side, and only a few commodities are there. And there also it's more futures, right? The commodity options volumes are not that big. So therefore, equities and currencies, if you're doing both futures options, then those categories are there. And commodity side restricted to some commodities, but on the future side. So managed futures and market neutral strategies probably can be done. And we do some of that. But again, there are some regulatory restrictions because, like I said, AIF regulations don't allow you to go more than 200% gross. Now, 200% gross is irrespective of equities or currencies or commodities. And on the currencies or commodities side, 200% gross actually means nothing. So therefore, you'll be restricted in terms of the types of strategies you can do. That is the only limitation in India. And fixed income side, I think we still don't have enough products out there in the market. It's mainly interest rate futures, and that is also not hugely liquid. And there are a lot of other sophisticated things that can be used for the quant researchers and portfolio managers globally is not present in India. So there we would look for the market to develop a lot more, right?
And what about portable alpha strategies?
Yes, so portable alpha strategies, obviously they would fall in high to moderate risk because you are taking risk there. You're porting alpha, but it's not as if you're necessarily low exposures and not exposed to risk. So they are exposed to risk similar to long only or long bias strategy.
Thanks, Rishi. With this, we bring the presentation, highly insightful presentation, to a close today. But we are not done yet. As a reminder to our listeners, please do complete the evaluation survey that appears on your screen at the end of the session. Also, please note that CFA Society and CFA Institute India members may claim professional learning credit by logging in their online professional learning tracking tool. But then don't also forget to register for these upcoming webinars. One is on 18th November, that's next Thursday, CIO's Insights, Investment Management Under Constraints by Amit Joshi. There's also on 23rd December, we have CEO's Insights Toolkit for Consistent Compounding from Saurabh Mukherjee. So with this, we bring the session to a close. Once again, thanks, Rishi, for your time. Really appreciate for the knowledge that you shared with us. Thank you all.
Sure, thank you. It was good to be part of the program.